Welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory for Chapter 8, which is about long-term and other assets. Let me get down here. Okay, so in this video, we're going to talk about intangible assets, and this video really isn't going to take that long, right? Intangible assets, what are they? Remember, up until now, we've been talking about fixed assets, okay? Fixed assets being things that we can actually touch, okay? But intangible assets are things that we can't touch, and examples of these are patents, copyrights, trademarks, brand names, franchises, and licenses. Now, I'm not going to explain all of these because, you probably know what they are. If you don't, go ahead and look it up in a dictionary, okay? Notice I didn't say anything about goodwill just yet, okay? So I'm going to talk about these first, and then I'll talk about the goodwill. And all I have to say about these, all right, is that they're treated basically the same way as a fixed asset. And with our fixed assets, we depreciate the fixed asset. So by now you should be very, very familiar with depreciation. Well, when it comes to intangible assets, instead of the word depreciation, they use the word amortization. Okay. Amortization is exactly the same as depreciation. You use the same exact methods. You can use straight line, and generally, most of the time, straight line is what's used because let's face it, it's hard to put a units of production on a copyright, okay? But, you can use straight line. You can use, double declining balance, all right? Of course, makers is, for taxation purposes, treats the amortization the way that treats. So really, there's no difference between, a thinking process between these intangible assets other than one, they're intangible, and two, we use the word amortization instead of depreciation. Okay, so that's it for those. But now let's talk about goodwill. And goodwill is really not that difficult either. And most of what you need to know about goodwill, you just read it in the textbook. As a matter of fact, that's all I'm going to do. All right. Goodwill does not mean goodwill amongst men. Okay. It refers to the excess of the cost to purchase of another company over the market value of its net assets. Okay. Um, if the market value of another company, say 100 million, okay, and you're willing to pay 110 million, okay, the difference between the two, that 10 million is goodwill. That's what it is, okay. Now, it has some unique features, unlike other tangible assets. Goodwill is recorded only by an acquiring company when it purchases another company. So when this company is going to pay the 10 million, it's the 110 million, it records the goodwill. The old company does not record goodwill. All right. Um, it says an outstanding reputation may create goodwill, but that company never records goodwill for its own business. Okay. And that's like an intangible. I mean, like you're buying that and you're feeling like, let's just say it's a brand. Okay. And, it, you're willing to pay more for it because of, you know, uh, that intangible factor for it. And so when we buy the, when this company buys this other company, okay, it's going to record its assets, it's going to record its liabilities, and the difference between the two is its net worth, right? Net worth, which is the 100 million, right? But they're going to actually pay the 110 million. So that extra 10 million, because of the goodwill that was created by that company, um, the new company records it on its books as 10 million in goodwill because that's what they're paying for. Okay, the other company records that as a gain. Okay, that as a gain of 10 million, and of course that's profit and that's taxable. Okay, whereas by purchasing this, um, notice what I just said. that's a gain. Okay, so that's a $10 million of profit that ends up that can be taxed. Okay, whereas taking the 10 million and recording it as goodwill, you're recording it as an asset. Okay, so there is no tax liability. It's like just buying a car. Okay, um, you're recording it as an asset. Okay, and then number two, according to GAAP, goodwill is not amortized. Okay, so even though all of these are amortized, goodwill is not amortized. Amortized. Um, Instead, the acquiring company measures the fair value of its goodwill each year. If the goodwill has increased in fair value, then there is nothing to record. But if the goodwill's fair value has decreased, then the company's records an impairment loss and writes the goodwill down. And you can see in the textbook an example of that journal entry. Okay. So that journal entry is recorded as a loss of impairment of goodwill. Okay, and then of course the goodwill, that's a credit to goodwill, will be decreased. All right, and you put in a description to record the decrease in fair value of goodwill. All right, so since you don't record, since now if like what in the textbook, they're kind of like saying, our goodwill amount was 100,000, and now we're writing it down by 20,000, right? So now, because of the loss, our goodwill is only $80,000. But notice that it says if the goodwill is increased in fair value, there is nothing to record. So in the next year, if the goodwill increases, you're not recording an increase to get back up to 100,000. Your goodwill now is at 80,000, so basically it can only go down. Okay, it won't go up. Right. So that's kind of like how that works. All right. The other thought that occurred to me, and I did mention this in the previous video, excuse me, on disposal of assets. Notice the terminology. All right. The terminology needs to be correct. All right. You can't just, if you have to memorize it, memorize it. Okay. It's loss of impairment of goodwill. And it was a gain on exchange in the previous video. Okay. Or it was a loss on disposal. Okay. You have to use the correct terminology when you're making these journal entries, because these will be general ledger accounts, okay, and you have to name them accordingly. You don't just automatically go and say loss on goodwill. All right, that is not an account. All right, it has to be the correct terminology. Loss on impairment of goodwill. If you're taking a test or you're excuse me, you're actually in the workplace and you do something like that, nah, sorry, you lose. All right. So that's just a forewarning. Make sure that you get the terminology correct. All right. So that's it for this video. Go ahead and watch it again. Relatively simple. Again, these are intangible and we amortize them, which is the same as using the same methods as we do for depreciation. Goodwill is unique and we explain that, so I'm not going to cover it again. All right, it isn't amortized, but you do have you do record the loss if the goodwill goes down. You don't record anything if the goodwill goes up, and it's only recorded by the purchasing company. Okay. Right, so with that said, that's it for intangible assets, and we'll move on to natural resources in the next one.